Get to the bottom of what this means in everyday terms and how it will affect all of our finances. I'm delighted to be joined by the head of macro research at AXA Investment Managers, David Page. David, thank you for taking the time this morning. I suppose on the one hand, everyone is discussing rate rises, saying that this is a historic rise, that 0.75% rise hasn't happened since, or basis point rise, I should say, hasn't happened since the early 1990s. And yet, on the other hand, interest rates are still at historic lows. And even a 0.75 rise at midday today would keep us far behind where the United States is. What's your view?
Well, I mean, both views are somewhat right. I mean, we're not at historic lows. The Bank of England's been tightening monetary policy since the back end of last year. So they've been gradually increasing rates. But yeah, other central banks have had to move more quickly. And it's, as you suggest, a response to the fact that we're seeing quite significant shocks coming through in energy. Now, the energy shocks themselves are something that should level out. So the impact that the energy shock has on inflation is reaching a peak over the next month or so, we think. We don't really know what's going to happen now after April as the government considers the energy price cap beyond that point. But we do think that as we move into the second half of next year, we'll start to see inflation come down. So the Bank of England sort of sees that there's a peak coming through in inflation, or there's an uncertainty around that. So that's from the energy side of things. But the labour market in the UK still is relatively tight. And that's really what the Bank of England's tightening monetary policy to achieve here today. It's likely to have to squeeze the economy, slow the economy, loosen the labour market a little bit. And that should guarantee that as we move into sort of 2024, we see inflation coming down back towards the Bank of England's inflation target. But the fact that we're seeing very sharp moves now does reflect the fact that, as you say, we're coming from a period of very low interest rates, and we're going to be moving up relatively quickly.
Of course, in September, we were expecting quite a sharp rise as well. Markets were expecting a 0.75 point rise, and the bank came out in the end with a 0.5 point rise, under expectations, and arguably contributed to some of that market turmoil that we saw in the days that followed, especially after the mini budget that came the next day. Was that a mistake from the Bank of England, the way they behaved in September?
No, I don't think so. I think it was just a reaction to the uncertainty of the government. I mean, very clearly, the market turmoil was nothing really to do with the Bank of England. They did a lot to calm the markets in the event of a very turbulent government backdrop. But I think in September, they were just completely uncertain about what the government was going to propose. So they were a little bit cautious in tightening policy going further forwards. The benefit of this meeting is that the bank also every quarter delivers medium-term economic forecasts. So that's what comes out today. In September, they were probably awaiting those forecasts a little bit, again adding to some of the cautious move now. But we do expect them to move by 75 basis points this time around.
Well, let's hope that they don't pull any rugs from underneath us and that market expectations are met, because it would be fairly messy if they weren't. But for now, David Page of AXA Investment Managers, thank you so much for joining us here on The Briefing this morning.